Welcome to the Clark Street Capital / Coleman webinar, The Road Ahead, Banking in a Changing Political and Economic Climate. Change is absolutely correct. We got Jason Kuwayama. He is a shareholder. Godfrey and Kahn, Edward Hida, Senior Executive Advisor, Secura Isaacs Group. Welcome, gentlemen. And Christopher Marinac, a Director of Research. I love that title. Of course, John Winick, your moderator, founder, CEO, Clark Street Capital. Hey, a couple of housekeeping things first. This will be on YouTube if you want to share the link with someone, and we'll have it up shortly after the presentation. Questions, use the chat box, and we will get those to you. Finally, we have a number of poll questions. Teams is a little clunky, but if you can find the chat box, you can answer the polls directly in them. John, this is a very timely webinar. I enjoy the webinars that you put together, and I love the speakers that you have, professionals all. Tell me why you have this particular topic at this point in time.
Well, I think the timing is very good because, as we'll hear from Chris's opening presentation, the vast majority of banks have reported earnings. So you now have some visibility on how banks did in the third quarter. And by the end of the day, Thursday, every bank would have submitted their call reports. Then on top of that, you've got a presidential election a week from today. So good time to kick it off. If we can, let's start with Chris Marinac from Janney Montgomery Scott with his overview on the banking industry.
John, thank you, and welcome everybody. We appreciate your time. It's a pleasure to be talking about the banking industry. It was a relatively positive third quarter. Lower interest rates particularly were helpful to the mark-to-market for banks' unrealized losses. But even beyond that, banks were profitable. They had limited growth in the quarter, which actually allowed them to retain earnings at a faster clip, and overall book value grew in the quarter. So we look at book value growing, roughly 5 to 8% for the major banks and mid-cap and community banks around the country. But that's a reported book value that has the recapture of unrealized marks on securities. The real way to think about it is that tangible book, excluding AOCI, was rising somewhere between 0.7 to 1.2% for your major banks that are $1 billion or higher. So think of your community banks that are public all the way up to JP Morgan and Bank America at the very high end had book value growth near 1% or thereabouts, excluding the AOCI marks. 90% of public banks had a positive growth in book this quarter, again, excluding the AOCI. So I was happy about that from the quarter. As we'll get into in a minute, I think that the credit quality data was certainly deteriorating in a standpoint of non-accrual loans and problems being recognized, but the real rubber where it meets the road is on charge-offs, and charge-offs were somewhat limited this quarter. And again, charge-offs are relatively restrained compared to history. And then we'll talk a little bit about some disclosures on commercial real estate and other observations as it relates to credit. One other point that we have in the next slide is, we are seeing the cost of funds peak. And the cost of funds is something that we look at very closely in the industry. It has been the pressure point why banks have had a narrower net interest margin the past 2 years, particularly as the Fed became aggressive in 2023 through the first half of 24 to raise interest rates to get all the way up to 5.33 on the effective Fed funds rate. And that was a very quick move from near zero in March of 2022 all the way to 5.33 during 2024. That had a difficulty for banks to accept their margins and keep them as strong as they were. Obviously, we had the liquidity crisis. I kind of call it mini March Madness of 2023 when the Silicon Valley Signature and First Republic failed. We're way beyond that now as an industry. We have certainly right-sized from credit, and I think deposits are back to growing. We can talk about that later. But I do think that from a cost of funds, we are peaking this quarter. And now with the Fed cutting rates in September and signaling more cuts ahead, you're beginning to see the crest lower of funding costs in this fourth quarter into the first quarter of next year. That's going to help net interest margins not only stabilize, but more importantly, start to expand. We think margins are going to expand slightly. We don't see any big knee-jerk reaction. We think it's a much more of a slight change than it is something seismic or significant. But we do think that the turn of net interest margin is helpful, and the bank stocks are trading better. We've seen some good activity in banks since the end of June, and even since the Fed cut on September 18th, we've seen banks slightly outperforming the S&P 500 through yesterday's trading. So I think credit quality, if we go to the next slide, continues to be the sort of front and center for investors. It's always the reason that bank stocks get hurt or get bigger multiples is because credit has a worse or better connotation and an expectation. I still think we're in the middle innings of the credit cycle. By no means are we done. By no means is it the beginning. I think we're kind of, think of it as the fourth or fifth inning, but there's a long ways to go, and we may have extra innings depending on how the economic behavior plays out. If we have a good economy for longer, it's going to stretch this out, but there is recognition of risk that still is happening. There still are deteriorations of loans. We still think banks are going to have charge-offs and reserve building. It's just going to vary company to company. And some of this was front-end loaded by the CECL accounting change of 2020, as well as the reserve building that kind of resumed after Silicon Valley failed. The graph or the tables that I brought today just show you what is happening in terms of net charge-offs, which I think is particularly important. The median net charge-off number is 48 basis points for the largest banks in the country. That is skewed by credit cards. I think if you take credit cards out, you would see losses at least in the upper 30s, if not more like the lower 30s for the large banks. And then for the mid cap and small cap community banks, they really don't do credit cards. So they tend to be a more commercial real estate and C&I driven loss number. Those tend to be, less than 15 basis points on median. And I think that the expectations are for those losses to be closer to 20 basis points in 25 and 26, and then the small community banks to write off about 15 basis points. It's a very benign loss rate relative to history. And the history is what we showed you with these averages in past cycle, very large losses from the great financial crisis era, 2007 to 2011, and then a little bit, more normal losses from 2012 to 2019 pre-COVID, but we're still below those levels in a pretty big way, particularly in the mid cap and small cap banks. We are looking at public bank data through yesterday, Monday, the 28th of October. The small and private banks who file with the FDIC will be available next week. And I think you're still going to find that overall, the loss trend is still very benign. We think that problems in the industry are rising for the natural reason of you still have incremental properties who will struggle. It could be a longer lease up for multifamily. It could be an office property that has gone awry, finally getting downgraded in terms of its valuation for an office property. Or it simply could just be debt service coverage is weak and it's now gone below that 1.2 threshold. The bank has to criticize it. It's leading to some past due and some default that's happening. These are still modest numbers compared to history on non-accruals, but they are getting worse, and it's sort of normal for me. I'm not really worried about credit per se from these statistics. I would simply tell you that the trend is going up, and it is true that we're coming off of the lows in 2020 on non-accruals and certainly past dues. The prior call reports from March and June had signaled that, and we think when we get through the call reports next week, we'll see more of the same. With that, we can talk about commercial real estate and some disclosures. I'll just mention real quick that in the two things that we looked at that I think are interesting for you, the next slide shows Bank of America. That is their disclosure on CRE and office. And if you look closely, you'll see about 1/3 of their office is criticized. That's a good number. If you look at their reserve building, it is being driven by the need to set aside more reserves for office. It's a small exposure for B of A in the office commercial real estate specifically, but it is something that they are addressing. They're very visible and they're very transparent about that number. Ed may talk about extend and pretend in the industry, and it's certainly an issue. I think for the biggest banks, they're not pretending anything. They are very open about trying to rationalize their portfolio with the proper watch list, special mention, substandard classifications. building reserves, setting those aside, and now taking charge-offs. If you look at the Truist graph, they've taken a higher charge-off ratio. That's 2 slides ahead. And the Truist graph is going to give you a perspective that, they've taken some medicine already, and we think that that medicine is going to continue to play out. And, remember, these banks have the earnings to address losses when they need to. So whether it's Truist or Bank America or any of the mid-cap and community banks that we track here at Janney, if they have some real estate issues, they will handle it through earnings, and they will take a provision expense through their PP&R and move on down the road. And that's above and beyond the reserves they already have. We think there's more of that coming, but it's not analogous to 2008 or 9 when you had major problems and losses hitting you everywhere, much bigger write-offs. These write-offs today are much more modest. You have less leverage today, but you do have some credit issues to deal with. So I don't want to give you too rosy or too sanguine of a credit view, because I think there are issues out there. I just think the losses are contained and so far very manageable. And the guidance from the public banks is more the same in terms of the level of charge-offs. And you can see that in some of the estimates that we gathered here.
Yeah.
It's the pink stuff in 2005 and 2000 or 25 and 26. So John, let me leave it there and turn it back to you, and I'll continue to add some comments.
That was great. I apologize. I think some of Chris's slides were cut off. They'll be sent out in the recap. But you mentioned the New York Fed critique of extend and pretend. Ed, I know you've got some knowledge on that. What do they do?
Yeah, so the New York Fed put out actually a very interesting paper last week, and it was a quantitative analysis studying the issue of banks potentially so-called extending and pretending on the loans. And in the analysis they did, they found persuasive, statistical evidence that this is occurring. I will say the population where they identified this was primarily in, I'll say, smaller to perhaps moderate-sized banks that are less well capitalized. And they identified in that population that there is an extend and pretend phenomenon going on. And there's a couple of perhaps upshots out of that, if you will. One is that by extending it continues to create kind of a bunched maturity wall as these loans are nearing maturity and then are all being extended. That then has some knock-on effects, which for those banks, they're doing less origination and new loans, and perhaps not assisting in the economy and things like that. And the result would be that there's a potential that in this sort of strata, you're going to have a delayed effect of this credit cycle through this extend and pretend scenario, perhaps waiting for more robust conditions or workouts to happen or other scenarios whereby those loans would ultimately be resolved or repaid. So I will say, it was, I think it's worth looking at. It did get a bit of, vigorous, I'll say online, debate and such. A number of folks, I think, kind of either didn't want to hear that or thought it, didn't make sense, if you will, in terms of the analysis. So it's a little controversial, but I thought the analysis is certainly worth looking at. And I think this whole credit space, and Chris rightly focused on, we're seeing a lot of different effects going on with different kinds of bank, different sectors and things like that. And it is, as Chris said, I think kind of, middle inning. So we're still seeing this play out. Clearly an area to focus on, but I thought a pretty notable piece of data there.
Yeah, John.
Yeah, well, I think it raised the issue of if banks are harvesting and extending and pretending their own credits, it's crowding out money that he could use to refinance everybody else's loans. And that's sort of the issue. Jason, what do you see on the credit side?
Yeah, John, let me just add to that, though. I think one thing that gets overlooked in this, especially when you're, and I think it's right to focus on some larger banks. And then as we get the call reports, start looking at maybe the non-public banks. But, a lot of the extend and pretend, to the extent it exists, is more than likely in the larger commercial exposure. credits that banks have. And if you're talking about that next sector, not the money center, maybe not the super regional, but that next sector, I think something that goes overlooked is that given the exposure of those credits, they're likely participated out. And that has a ripple effect among a lot of different banks in that sort of next echelon of size. If they're relying on appraisals, and the leads analysis of that credit and that leads decision on what to do with that credit, it can potentially have, I think, a larger effect than maybe is being perceived at this point.
Yeah.
John, generally, just to address credit, I guess I'm in the camp that maybe controversially probably tends to agree more with the Fed's analysis of extend and pretend. I don't necessarily think you can blame banks and call it some sinister extend and pretend like you did in GFC 1.0, because I think that some of the CECL rules have promoted the way in which banks are treating these credits in terms of repatriating them and getting them, since TDR doesn't really exist, getting them back on the performing side, so they don't necessarily have to reserve for them. And so I think they're just taking advantage of the tools that are out there. It's interesting that Chris brought up the estimated amount of losses on the credit card portfolios, which is squarely in the consumer sector. And we've talked, John, you and I have talked about this at length, but I think the biggest concern, we all talk about CRE, we all talk about office leasing and maybe some multifamily. But I really think the biggest concern in 2025 is going to come from the consumer side of credit, and what effect that is going to have then potentially on commercial credits. I can't predict that. And I don't know. I know, John, you're going to talk about the election later. I don't know what that effect is going to have. That's sort of outside of my wheelhouse. But where I've seen the biggest sensitivities are either on deteriorating credit conditions in consumer, or banks that are simply stuck with long-term fixed consumer loans that are below market, potentially on average 2% below current yield right now, and that's actually hurting banks quite a bit on their margins.
We have a poll question on interest rates, since we're kind of touching on the rate environment. You have to go to the chat function to see the poll question. So big question on where will the federal funds rate be in the end of the second quarter, June 30th, 2024? Will it be the same or higher, lower by 25 or 50 basis points, lower by 75 or 100 basis points, or greater than 100 basis points lower?
John, I assume you mean 2025?
Yes, 2025.
Just checking.
My bad. They're starting to come in. While they're coming in, Chris, I mean, the AOCI issues, the banks made a lot of progress. Did they give some of that progress back with the 10-year rallying 40 basis points in the past 30 days?
Well, sure. In theory, if we close the quarter today, John, you would give at least half of it back, maybe more. It remains to be seen where we're going to be. I mean, I certainly understand why interest rates have moved back up, but a lot's going to happen in the month of November and December. We may still have the inflation concern and the steeper curve that has begun to form, and that could change the AOCI numbers. The interesting thing is the banks are continuing to make money. So if they do have to see AOCI retreat somewhat after this big recovery in Q3, it's not that big of a deal. It's more of a nuisance, to be honest with you. What I think is starting to form is that the curve was inverted for so long. We're now beginning to get just a little bit of positivity between 2-year and 10-year rates, possibly more as time passes. That's actually going to be productive for banks' net interest margins. Banks can make a better spread under a steeper yield curve than they can inverted, and it'll make them easier for them to generate revenue. So at the end of the day, I think we can kind of navigate it. I wouldn't lose too much sleep over the AOCI, but it is interesting that you had this big move where actually the average pickup is about 30% from June to September. You may give back 15 of that 30, given how rates are today, which is, your point, and well taken.
Yeah, and the consensus in the poll, lower by 25 or 50 basis points. That was my vote as well. I mean, certainly rates are coming down, but perhaps not as fast as everybody thought. I mean, Chris, one thing I've noticed in bank earnings and what I've seen so far is the margin picture might be starting to turn positive for banks. Intuitively, if you've got a borrower that's now paying an above market interest rate on a loan, let's say they're paying 8%, and they come to the bank and say, lower my rate or I'm going to move. A lot of those borrowers are going to find when credit is tight, as you mentioned earlier on new CRE originations, those loans are going to be stickier, and banks are going to be able to hold on longer on higher yielding loans, and the deposit pricing will come down. So, I mean, do you think the margin picture is starting to turn for banks?
It is, and I didn't bring this graph, but the data would suggest that the consensus for margin is going to move about 15 basis points. I personally think that's a little bit too rosy. I think in terms of maybe 7 to 10, but that's also just me being conservative as an analyst who does models for a living. And I also think to some extent that the deposit movement is going to vary widely by company. A lot of companies are lowering deposit costs, but it has to do more with CD pricing, wholesale funds. They really haven't moved money market rates as aggressively as they could. That's where the second and third Fed cut come in. If we get those in November and December, then it's going to be helpful to the bank's deposit pricing at year end, which is going to enter 2025 in a much better spot. But I think it remains to be seen because competitively, it's still a pretty good battle out there for funding. We are seeing deposits grow. The national Fed data has been positive in Q3 and also so far early in Q4. So I'm optimistic that deposit outflows are, part of the history of 2023 and not part of 24. We are up for the year, so that's a good thing. And I think overall the pricing is really going to be key. But the Fed's going to lead that pricing. If we see the Fed being more aggressive on the way down, then that's going to make it easier for banks to lower rates. We're just going to have to see. I feel like there's going to be a back and forth on interest rates. Some quarters we get a policy cut, some we don't, and that the Fed futures are probably overshooting what's going to happen in reality.
Yeah, John, one thing I would add to what Chris said, and I completely agree. I think that deposit outflows have stabilized, but on the regulatory side, although they are being patient, the regulators have really pushed banks to reduce their reliance on wholesale funding, and banks, have responded by getting a bigger concentration of core deposits. While I think, and this is anecdotal, but while I think maintaining a relatively similar cost of funding, so that reliance on those core deposits, I think ultimately will help them going forward.
Yeah. Well, we've got an election coming up next week. Just a quick little few of my slides. Obviously, this election's hard to predict, but certainly the presidential and House races are very difficult to predict, and in my view, could go in any direction. But one thing that seems fairly certain is you're very likely to have a Republican Senate. You could see this is from Real Clear Politics. You could see all the open Senate races, and quite frankly, the math is just more favorable to the Republicans. There just are not really many close races in which a Republican is defending their seat. You could see here, there's basically 3 races where a Republican senator is in any sort of jeopardy, and there's a total of 6, 8, 9 Democratic seats. So if you go to the next slide, the West Virginia Senate race is pretty much over. You have a lead by Governor Justice by over 30 points. So that would take the balance in the Senate to 50-50. And the other race that appears to be likely strongly leaning Republican is the Montana Senate race, where Senator Tester has been pretty consistently losing in the polls by about 5 to 6 points. And there just aren't many vulnerable Republicans, probably Ted Cruz, and there's a handful of other Senate races that are close, Pennsylvania, Ohio, where you have Democratic senators defending seats. So it seems very likely that you're going to have a Republican Senate. Almost certain it'll be 50-50. Now, it's not going to be a big majority, but I think the likelihood of divided government is very high, given that scenario. In the betting markets right now, you have to wager $450 to win $100 on the Republicans winning the Senate. So it does seem like that appears to be likely. Thoughts, gentlemen, on divided government? Does it seem like we're headed that way?
Yeah, I think, John, your point on divided government is right. And while we don't know yet, and probably take a few days to understand what's going on with the general election, certainly the possibility of divided government is pretty high. And what that tends to mean is that the whatever administration is in power obviously has less ability to enact a lot of their priorities that require legislation. And so you tend to have some of the more extreme effects on whichever side wins the presidency dampered through divided government, or as others call it, gridlock. So I think that's a fairly likely scenario. Certainly there are some sweep scenarios on either side, maybe less with what you just presented on the Senate race, but I think there are some sweep scenarios out there, and that would obviously enable that party to have a more activist agenda if we saw that. But it's not looking that way for the most part.
Jason? Thank you.
Yeah, well, I read a story this morning that, just from a pricing standpoint, the economy has essentially already priced in what they think is going to happen. And so I wouldn't expect any major changes in terms of just the market itself. My comment would be that if we have a divided government, I think you would continue to see the regulatory environment that we're in. If one party, specifically Republicans, take control, I think there would be optimism in the banking industry generally that they could see some reduced regulation. I'm not overly convinced of that. I tend to think that the regulators, and when I say the regulators, I specifically mean the OCC, the Fed, and FDIC, and then the state banking regulators, I think largely act independently, of that. CFPB maybe a little differently, but I wouldn't see any sort of immediate reduction in regulation. Maybe long term, yeah, there'd be some easing and some optimism with banks, but really, I think it's obviously too early to tell, a week too early to tell, but maybe 2 weeks, who knows? But I think that if there were to be any changes down the pipe, they would be at least a year away.
Yeah. Well, let's see what the audience thinks. We have 2 poll questions, and they're all related to what the future is of bank regulation. And we can cue those up at the same time. One is, if Kamala Harris wins the presidency, what impact do you think it'll have on bank regulation? Significantly more, moderately more, no change, and then moderately less, significantly less. And then the same question if Donald Trump wins the presidency. I'm curious to see what the audience has to say. I don't know if we can pull both.
John, should people assume that if Kamala Harris wins, that Elizabeth Warren would be in some sort of bank supervisory role?
I think she will certainly have a veto power. I don't think anyone's going to be in any of those regulatory seats that she opposes. Sir, I think that's a fair statement. Let's see. I'm trying to see the votes on this. Okay. Do we have any of the results yet? I can't see them.
Yeah, you should be able to hit view poll in the chat and it'll pull up the results for you.
Got it. Okay.
Perfect.
I guess I got to vote myself. Okay. Let's see. Okay. Kamala Harris wins the presidency. What impact do you think it'll have on bank regulation? Nobody said less. 14% said no change. And it looks like 47% moderately more regulation, significantly more regulation, 40%. And if President Trump wins, obviously a very big difference here. 73% said moderately less regulation. So it definitely seems like the winner of the presidency will have some impact on the regulatory environment. Chris, what are you hearing from your bank clients?
John, I think the expectation is that the regulatory environment has gone too far in terms of being difficult the last couple of years, and that it would get easier under a White House change. I'm afraid that that is a little bit wishful thinking. And I say that from the perspective that the rank and file at the OCC and the FDIC and the Fed really run the business, and those men and women are professional, staffers, and they really dictate what happens. I think there has been a very tight control around AML and BSA, around some of the CRA regulations, around some of the pertinent items before a bank merger is approved. All of that is going to stay intact, in my opinion, for quite some time. We may have a change in the White House that changes the leadership at the FDIC. It doesn't necessarily influence the day-to-day operators at the FDIC or the Fed or the OCC. So that's the point that I would really hone in on. I know the markets had this great rally in late 2016 and early 2017. That doesn't necessarily mean it happens now. It's a whole different ballgame today than it would have been several years ago. I just think the industry sets up to be more optimistic coming into this election versus being very pessimistic coming into the 2016 election. So just a little bit of just caveat there. I do think the industry is moving forward. I think it is a rule-based industry. It always has been. And I think that most of the banks who are in the business understand and are trying to abide by those rules. We are going to see M&A. And we'll talk about that at some point today. I think M&A will continue to be a critical theme. I think the pace of M&A is going to have more to do with stock prices, outlooks on credit, than the regulatory side itself.
Yeah, I think you saw Jamie Dimon this week said regarding regulation, it's time to fight back. I've had it with this shit. So
Yeah,
definitely seeing some bankers speaking up.
That was notable. I think on the point on, regulation, coming out of the presidential election, I think, you and Chris have summarized a lot of the points correctly. One additional point I would make, which is, I think, important, but kind of adjacent to banking, is around crypto. And the Trump campaign has specifically made a number of very pro-crypto policy statements, supporting things like a government stockpile of crypto, actually, kind of a crypto advisory council, and blocking the Federal Reserve from creating a digital currency, presumably to enable other crypto assets. And that could be an interesting area if Trump were elected, to have a real pro-crypto administration, and what the impact of that would be on banking. So more to come on that.
Yeah, I would note, though, that I think implicit in that is, if the government's going to get involved more directly in crypto, it just brings along with it more regulation, right? I mean, that's how they get involved.
Sure.
Yeah. Well, we kind of chatted about M&A. Just last week, no one would have ever thought that state attorney generals would get involved in bank mergers, but the New York State Attorney General is trying to get in the way of the Capital One Discover deal. So, it does seem like there's a lot of hostility towards bank mergers, particularly when it's a consumer-oriented lender. Jason, what do you see as outlook for M&A after the election?
It's hard to say. I think M&A has started, it was hot in 2021, 2022. I think it slowed down a little bit in 2023 and early 24. It started to pick up now. I think if you see, and I'm bullish on this, if you see a Republican presidency, I would actually not expect a significant uptick in M&A, at least in the lower asset size banks, because I think right now the smaller banks are struggling to survive under the pressures of this increased regulatory environment, and frankly oppressive regulatory environment. And M&A is a way to solve that. If they perceive reduced regulatory environment going forward, perhaps it's an opportunity to stay independent. And so I think you have to balance that with everything that Chris was talking about earlier, with NIM potentially getting better and banks seeing multiples start to climb again. If there's optimism and we stabilize our economy and NIM increases and banks are starting to make more money, I think you'll see multiples grow and you'll see sellers who were sitting on the sidelines start to sell. So I think that's a long-winded way of saying it depends, which is your classic lawyer answer, right? It really depends, and it's hard to predict, but I do think that the regulatory piece of things does have a real cost for banks, a real cost. And if we do see a reduced regulatory environment, that might be enough for a bank to stay independent for a little bit longer.
Yeah. I mean, it does seem like the more punitive enforcement actions are getting harsher. I mean, TD Bank basically got the death penalty, a $3 billion fine, a criminal conviction, which is very, very rare. It's in the single digits of U.S. banks that have pled guilty to a felony. Plus, they got an asset cap as well. Then you had the CFPB basically putting Nelnet, the largest student loan servicer, out of business and basically describing them as a criminal enterprise. I mean, it does seem like the gotcha factor is higher.
Yeah, I mean, let's be clear though. Major AML BSA violations would be a prohibition to consummating a transaction in the first place, right? And so we've had long a history of banks that have committed some notable AML BSA violations that make the paper. I do personally see increased scrutiny on AML BSA compliance in annual regulatory exams. Regulators making notes of it. And so I think there probably is a little bit more scrutiny in that area, but I don't know that increased enforcement and the punitive nature of the enforcements is really going to have a significant impact on M&A in and of itself any more than it has always had.
Yeah, I was just looking at some research that a consulting group called Claros did, and they studied enforcement actions, and the most recent enforcement actions in terms of areas of focus were BSA, AML, third-party risk management, and board governance. And I think that really plays out that, that is a significant area of focus in the exams. I think, another, note is that the OCC actually recently published at the beginning of the month their operating plan for next year, and it kind of lays out their priorities. And I guess it's good, but there were 14 areas of focus for 2025 versus 13 in 2024, and they added to the existing priorities capital and third-party risks, and then they deleted distributed ledger technologies. So, clearly there's a lot going on, but as I said, the areas that were caught up most in enforcement actions were BSA, AML, third-party risk, and board governance.
Chris, I mean, are you hearing from your public banks? They're probably not as vocal as Mr. Diamond, but are they, complaining offline about how harsh the regulatory environment is today?
Well, I think their complaints have been a little bit muted because the complaining happened 18 months ago, and after the course of time, it gets a little softer because it becomes the new normal. I think there's an acceptance that there are going to be new liquidity rules, whether it's at the largest banks and pushed on down the system, or that there is going to be some tweaks to capital in general because of what happened in 2023. Having said that, I think that there is a quiet revolt happening. The question is, can they be successful? And this is where politics comes in. There's a lot of politics involved on both sides of the aisle, trying to sort of put the banks in whatever place folks want to do. I think the reality is the banks are part of the solution, not part of the problem. The banks are out there lending. The banks were part of PPP. They certainly can create more opportunities for small and medium-sized businesses. That's what they do. And I think that unfortunately, they're kind of caught in the middle. But banks are used to this. This is not the first time we've had this rodeo of regulatory sort of kerfluffles, and we'll have more. And I think we'll get through this as an industry. I think ultimately some banks give up their independence because they want to sort of get out of the noise. But the banks that stick around and are successful at growing their business and taking it to the next level certainly understand how to work within those channels, even if the rules are changing. There's many bank that are mid cap and even larger who can navigate these waters, even if it is a volatile regulatory scene, which it feels like it's going to be for a while.
Yeah, I mean, I know, Ed, you have some inside knowledge of this. I mean, it sounds like from Barr's speech, I think it was last month, that the Fed is backing off from higher capital standards. I don't think I've seen anything more on that. Where do you think we end up? What direction do you think they're going?
Yeah, let me just take a minute to kind of refresh a little bit here. We're talking about the so-called Basel III endgame or Basel III capital standards, and essentially that's a set of rules to determine capital requirements for banks. Was proposed 2023, would have primarily applied to banks over 100 billion in assets. As is the typical rulemaking process for capital, it was jointly put out by the Fed, OCC, and FDIC, subject to a comment period. Got a fairly, let's say, vigorous reaction. Comment period was extended. I think when I saw some analysis, 97% of all comments coming in were negative on it. As a result, we had Jerome Powell give a speech several months ago saying that significant revisions were required and that a reproposal was required. Following that, we had, John, as you mentioned, Michael Barr, who's the vice chair of supervision at the Fed, gave a speech, and fairly detailed speech, actually. He not only followed through on Jerome Powell's comments about a reproposal, but he gave fairly specific commentary about what that would be. And perhaps most notably, the threshold for applying these rules was shifted from 100 billion up to about 250 billion. Few exceptions, but primarily those banks and larger. Many of the rules in the original proposal would have so-called gold-plated or enhanced the requirements that are coming out of the international standards. In the reproposal mentioned in the speech, much of that gold plating was removed, so relied more, say, commonly on what other jurisdictions are doing and presumably giving a level playing field. Additionally, in that speech, Michael Barr said that we would have the capital rule fairly soon. There was some indication it would be forthcoming, and also that it would be that the agencies were all in agreement, the Fed, OCC, and FDIC. Now, weeks have gone by. We have no reproposed capital rule, so it raises the question: where are we, and what's going on? And it appears that based on some reporting and things that there's an impasse, primarily at the FDIC in terms of reaching agreement on the reproposal, and there's some board directors there who believe that the reproposal doesn't go far enough in reducing some of the requirements, and there's some others who believe that it goes too far, and that as a result, the agencies should revert to the original Basel III proposal. And so we're at an impasse. So what could happen? Well, there's one scenario, and I don't think it's likely, that the Fed could on its own issue the Basel III reproposal. Given our date of where we are in the upcoming presidential election, I think a more likely scenario is that there's some inaction waiting for to understand what happens in the presidential election, what happens with Congress, and are there any changes in leadership at the federal banking agencies, and what does that mean going forward in terms of what the priorities are on this, and what the sort of parties in power want to push in terms of a reproposal. So I think we're stuck right now, and I think we're probably waiting for election results to see what the landscape is in terms of the leadership. But different things could happen at the same time.
The short answer is that the capital hit to banks is not going to be as bad, right?
The capital hit was that Michael Barr talked about was fairly significantly reduced from what was estimated in the original proposal. And I think that still remains actually one of the points of contention, is that especially in larger banks that are generally well capitalized, they believe that the capital increase that's still remaining in the so-called reproposal outlined in Michael Barr's speech is still too high, too significant, and unneeded and unwarranted. And I think there's a possibility of, you talked about Jamie's comments. I think Basel III would probably be included in the areas that he's talking about in terms of regulation. And so I think there's a possibility of industry action.
Jason.
Well, John, I think the reason we haven't heard anything is I don't see any one regulator stepping out and enacting rules. I think for parity reasons, that is are going to be a bad idea, and they know that. I know that they probably disagree amongst themselves, and that's not a bad thing, right? I mean, their disagreement means that ultimately, like, their job is to regulate banks, and I don't think for the most part they want to put banks out of business, and they want banks to be successful and healthy. I think it's sort of a parenting fight over what the best way to parent the children is really what it comes down to. But they're not going to tell any child what the new set of rules are until they both agree on it. And I think that's sort of what's going on here. I think the backdrop too is potentially going back to something Chris said as well, that the Chevron case, just to bring in a little legal analysis here, the Chevron case potentially has given some power to the banks. John, you mentioned Jamie Dimon.
Sorry, Chevron case, Jason, can you elaborate?
So this is Chevron versus the EPA. This is a case that, in essence, and I'm not going to bore people with legal analysis here, but it's a U.S. Supreme Court that came out and in essence says it neuters administrative agencies and says that administrative agencies only have the specific power given to them in the statute. They aren't these bodies that can become quasi-regulators just because they have a charter to regulate. Now, it was in the context of the EPA, but the Supreme Court didn't limit it to that, of course. They limited it to, or they addressed it on the guise of administrative agencies, which the banking regulators are. And so I think that there's probably some discussion amongst the regulators thinking that, hey, if any one regulator comes out and does something that we don't all agree on, it could potentially be challenged. If there was a regulation that affected Chase disproportionately, and Jamie Dimon's to be believed at his word, maybe they use Chevron and they file something. I doubt that would be the case. I'm being hyperbolic here, but I'm just saying that I think that case and also in the context of the regulators trying to put on a unified front has just caused a pause to what was probably an overreaction last year.
Yeah. If anyone has any questions, please send them in the chat function. We are hearing that they're more interested in FinTech, and there's some efforts to, rein in some of these FinTech partnerships. What are you all hearing there?
Yeah,
go ahead.
Yeah, I think that's absolutely true. I think the question that the regulators have in effect is, are FinTechs and banks with their partnerships of FinTechs using that partnership as a way to provide banking services through the FinTech that's not under sufficient regulation and not within what some of my colleagues have called the sort of regulatory perimeter of the regulated banks, the regulator, and the products and services that are within that. So the question is, has this current environment opened up to allow through these partnerships fintechs to offer these services without sufficient supervision. And so you get the regulators then looking at the partnerships that the banks have with the fintechs. And I think that, there was some other analysis I saw done by a consulting firm, and they saw that about half of, in some categories, I think it was enforcement actions for state non-member banks, were with partner banks, so banks that provided services through a fintech. And, I think they also looked at things like the probability of receiving an enforcement action if you were a partner bank. And it varied by regulator, but was about 15% if your primary federal regulator was the FDIC. And this is also from Claros Group, a consulting group. But clearly it's an area of focus and an area that the examiners are diving into in their examinations, and certainly warrants a lot of attention by partner banks to make sure that they have the right risk management controls, governance, all that AML around that relationship.
Yeah, John.
Well, on the technology side, sorry, Jason.
I was just saying, rein in is probably not the right word. I mean, I think the regulators have expressed publicly support for wanting to explore the feasibility and continued possibility of expanding these relationships. But increased scrutiny, I think, is the better way to say it, is that certainly banks that have made it their business model to, be a bank that's banking as a service are going to come under significant scrutiny in the coming quarters.
Well, I raised a question about technology. I mean, Chris, do you think the technology gap between, say, the big four banks and sort of the PNCs of the world to then sort of the middle-sized and smaller public banks, you think that technology gap is stabilizing, shrinking, getting bigger?
Oh, it's definitely shrinking for sure. I mean, I think you have technology the last 2-3 years that has leveled the playing field in many cases. You just have bigger dollars that Bank of America and JPM can spend. And so they're going to be the lead horse on the technology side. But by the same token, I think the point on fintech is that some of the fintechs have misrepresented the FDIC and deposit insurance, and those are just sheer absolute violations of what the regulatory conduct is. And so when those parties are out of line, you're going to see the FDIC and OCC clamp down. And that's exactly what happened back in September when you had the conference. I believe it was on the 24th of September that they had that joint call. To some extent, the parties who are out of line are going to step back and stop doing partnerships because they're going to be nervous of getting their hands slapped. The ones who are successful are those who understand how to run their fintech business and partnership and third-party management through the proper channels and move forward. There are going to be market share gains by banks who do that correctly and play within the rules. By the same token, there are fintechs who can partner with banks and make very good revenue by playing within the right channel. But you have to play by the FDIC and OCC's rules. It's a critical function, and there have been some real mistakes done the past few years.
Bob, you got any questions, Bob?
I had a follow-up for Edward. Would your answer on the fintechs also flow over to CDFIs? I'm really fascinated, and I don't know the backstory of City National Bank giving $5 million to a CDFI here in Southern California called Lendistry. And it was for small business lending, make smaller loans. Do you have any information on that, or any of you have that? I just don't know that much about it, and I find it fascinating.
I didn't follow that one. I'm not sure if others did, but I didn't follow that one.
Well, let me ask you this. Your answer is CDFIs. Can you comment on that and what's happening with banks and funding CDFIs, basically? Not to stump you. I'm sorry.
I think the general comment that, banks partnering with other institutions, funds, the like, need to have sufficient risk management, compliance, governance, BSA, AML, all the usual sort of regulation applies there as well. And, you can't go into a partnership with another institution and, allow, because they're less regulated or non-regulated, that environment to pervade in your business. So I think that principle still applies
Yeah,
there.
I agree.
Yeah, but what I'm seeing, Bob,
Go ahead, John.
yeah, what I'm seeing in a lot of cases with CDFIs is other banks are investing in CDFIs because they feel the CDFIs are better at doing some, sensitive, urban, difficult lending on difficult property types like churches or other stuff that's challenging. And, better to invest in a platform that gets it and is mission oriented and is geared towards it than trying to do it half-ass yourself.
Yeah, Bob, there are banks that apply for and get CDFI grants.
Right.
But there should be at least significant controls and compliance on how those funds are deployed and used, and then reporting on that.
Yeah, and John, follow up with you, John, is I just don't understand. Bankers, they're smart people and they understand risk. When do you make the decision to, okay, we're going to run this program in-house and we're going to meet these policy projected goals versus, we'll just outsource it to a third party? That's what it seems to me, John.
Well, it seems, a lot of this has to do with CRA, right?
I understand.
So, you've got a lending and an investment test, and that's what's likely motivating these types of endeavors is a CRA need, and the CRA rules are going to change. There's been a proposal. My understanding is it's blocked in court, but you can assume that it'll be more difficult, not less difficult, to meet your CRA needs. And so partnerships are going to increasingly be a good way to do that.
And Bob, I would add that the CDFIs were and are administered through the U.S. Treasury Department. There was some additional capital given to those banks as part of the tax code change in 2021. And so that ESIP money, it's emergency capital for improvement, the Treasury dictates, very attractive capital for about 140 banks and credit unions who participated. It's a unique program that is going to cover a few institutions, such as the one you referenced. It's not for everybody, but for those banks who will do that, it's a very unique program. There is and it will continue to be that type of lending done within the smaller community banks. There are only a handful of public banks, less than 10, and I think actually maybe less than 5, who are publicly traded that are in the CDFI program, but they are doing quite well using the program and getting tax credit awards and things of that nature to really help their individual communities. So it remains a very interesting and I think so far productive subset of the U.S. Treasury.
Excellent. Thanks, guys.
Bob, you want to take us away?
Oh, I have one more question. I was asked the other day, what would a Trump administration look like for the banking industry? And I made a comment as I think what they did in 2016, you can see rehash of 2024. Was I wrong?
Yeah. Surprisingly, the topic is fairly bipartisan. So I was at a banking conference 3 weeks ago, and the former comptroller of the currency, he started promontory. His name's escaped me for a second. Chris, what was his name?
Eugene Ludwig.
Gene Ludwig. Yeah. So Gene Ludwig gave a speech at dinner, and he was appointed by the Clinton administration. And he said the regulatory environment has become so oppressive, it has to stop, it has to change. And, obviously he's a Democrat. So, there is a bipartisan consensus, I think, to rein in some excess regulation. And then obviously you've got the Elizabeth Warren crowd, which wants more. But it does seem like there is some bipartisan momentum to slow some of this down. So I think a Trump administration, or even, you might see more movement that direction.
John, as always, excellent topics. What do you have planned coming up after the election?
Stay tuned. I think we're probably going to do another commercial real estate webinar. It's been about 6-7 months since we've done that. And obviously bring these guys back in 6 months or so. So,
or if it's a Harris victory, I want to hear more. I want to hear more what's going to happen with the Elizabeth Warren crowd. That could be wild.
Yeah, I honestly, the election, because of what happened the last two cycles where the polls severely undercut Trump's support, if the same thing happens again, then he wins easily, or they could have overcorrected so much that she wins easily. So I think it's very hard to predict. And the House races, there's just no good polling for House races. So, someone that's leading by 10 points could lose by 10 points. So the House.
Well, John, I thought you took a very sensitive topic and handled it very well, very balanced. So good for you. Hey, I'm going to do a plug. If the SBA secondary market is important to you and it's going to send you information, we're having an event on December 5th in Washington, D.C. We have the SBA personnel from D.C. We have secondary market brokers, as well as at the end investors. So if that's important to your institution, consider attending in DC. And with that, gentlemen, excellent presentation. Thank you all very much. Stay tuned and we'll get the next webinar out to you. Have a nice weekend.
Sounds good. Thanks, everyone.
Or week.
Thanks, everyone.